An index called the VIX was flashing a major warning signal right before the start of the great financial crisis. This is the market's expectation of future volatility. And after having gone down steadily for multiple years in the early 2000s, between February and July of 2007, this indicator began to move up from a historically low level of 10, tripling to reach 30. Now, a couple of months later, in October of 2007, the stock market made its last all-time high before beginning a 60% decline during the Great Recession. Fast forward to today, and we've seen something similar. This VIX index has gone from steadily trending lower for the last few years, hitting a low of around 12, and now just over the last couple of months, we've seen the VIX move considerably higher in a similar fashion to the way it did in early 2007. So first, what on earth is the VIX? The VIX is an index that measures the price of options that are being placed on the market, whether that's call or put options. If traders are betting big on options, it means that they're expecting larger moves from stocks in the future, or what we can also label as volatility. When this is the case, the VIX shows a higher reading. Now, in most cases where the VIX spikes, that's usually accompanied by a drop in the stock market. That's simply because when the market is going down, it usually sees a larger moves. And so options traders are making bigger bets on the market that's reflected in a higher VIX reading. So when the VIX started to rise in early 2007, despite the stock market being at all-time highs, it suggested that options traders were betting that the market was likely going to go down, and they were eventually right. But we can also fast forward to 2022 and see that they did the exact same thing. Between October of 2021 and January of 2022, the VIX started to rise considerably despite the stock market being at all-time highs during this period. Eventually, the S&P 500 turned around and began a 25% decline, proving the options traders correct once again. So at a first glance, it seems that when the VIX is rising with the stock market at all-time highs, it's not a particularly great sign for the stock market. But as always, there's a catch. Large moves on the stock market don't always occur to the downside. Believe it or not, you can also see the stock market make large moves to the upside. So theoretically, a rising VIX can also mean that options traders are expecting the market to accelerate higher. That's exactly what happened in 1995. After having made a low of about 10 in January of 1995, the VIX began to trend higher in a similar fashion to the way it did in 2007, 2022, and 2024. Now you can see this also happened with the stock market at all-time highs. In fact, as the VIX was rising, the stock market actually began to melt up higher. This wasn't followed by a big crash like 2007 and 2022. The stock market continued melting up for another 5 years. In fact, the moment where the VIX started to rise was when the US stock market actually broke out of a very steady uptrend and began to accelerate higher. So one thing is sure is that options traders today are expecting larger moves from stocks. But are these larger moves going to look like 1995, or are they going to look like 2008? At a first glance, we do have some similarities between today and 1995. For starters, in both of these instances, the Federal Reserve, the US central bank, has been cutting interest rates. And that often gets investors quite excited, because when the Federal Reserve is cutting interest rates, it means they are lowering the price to borrow money in an attempt to stimulate economic growth. And so when investors see this, they can get more excited about future economic growth. This is a chart of the Federal Reserve's interest rate going back to 1990. This is when they cut interest rates in 1995, and this is what's happening today. Now, in both of these cases, the Federal Reserve is cutting interest rates outside of an economic recession. These gray bars you see here show us when all of the recessions occurred in the US over the last 35 years as classified by the NBER. Now, in most cases, the Federal Reserve is cutting interest rates during recession, much like here in 2007. So that doesn't really do much to push the stock market higher. In 1995, however, they began to cut interest rates outside of a recession, which is what led to the melt up in the stock market that occurred at that time. We saw something very similar in 1984, where the Federal Reserve was also cutting interest rates outside of a recession, which also led to a kind of melt up in the stock market that eventually ended with the 1987 crash. So this is exactly what they're doing today. The Federal Reserve is cutting interest rates despite the fact that no recession has yet to materialize in the United States, at least for now. And that's where things start to get a little bit more complicated, because we do have signs that the US economy is starting to see some cracks and could be very close to completely completely breaking, and that of course wouldn't be accompanied by a melt-up in the stock market. The number of states that currently have a rising unemployment rate is going up quite rapidly. This is typically something that you see before or right at the beginning of economic recessions. For example, we saw something similar in 2007. We have many more data points that are still pointing to a recession materializing by the end of 2024, and believe it or not, we remain quite confident in that call. However, we absolutely cannot deny the strength of the stock market today. So the rising volatility that we're seeing today has some elements of 1995 and some elements of 2007. And what we're saying to our clients right now is that as long as there's no recession, this could be a sign that the market is accelerating higher right now in a similar way to what it did in 1995. But when the economy does begin to enter a recession, we'll likely see the stock market get hit very hard. Now, in the short term, if you've seen our last couple of videos, we actually turned short-term bearish on the stock market right here. We posted a video laying out our entire reasoning called "The Stock Market is About to Get Rug Pulled," and we sent out sell alerts to our clients to book profit on a bunch of our trades at bravosresearch.com, even initiating a couple of short trades on the market that are so far up very nicely. The market has been correcting quite violently over the last couple of trading sessions, and we're currently closely watching for signs of a bottom to buy back into the market and add the setups that have been on our watch list. You can have access to our entire trading strategy at bravosresearch.com. We take you step by step through each trade from the initiation to the closure, and you can check out all of our recent closed trades on the homepage of our website.